Welcome, everyone. We're going to get started because I know everybody has other things to do aside from us. Thank you for joining us. We're going to get started with welcoming Professor Harmeet Singh, that has been gracious enough to present this month for our Financial Literacy Seminar series. Professor Singh serves as a professor of practice at the Texas A&M University Kingsville at the College of Business Administration, where he teaches finance and economic courses. Professor Harmeet has been recognized with the Texas Digital Learning Association Excellence in Digital Learning and Innovation Award and serves as a faculty fellow for the Center for Faculty Excellence. His discipline-specific research interests span pricing and revenue management, market structure, and financial analysis, pedagogy research in academic integrity, and online learning outcomes. Welcome, Professor, and the stage is yours.
Thank you very much, Ms. Arias. Okay, so I put it in the chat as we get started. Please feel free to introduce yourself. We are a small group, so your name, your major if you're a student, if you're staff, your name and department, we'll all get to know each other. And I see some of the student names from my classes enrolled, so I'm very happy to see you all here. And I'll get going as we all post in the chat. Okay, so today we are talking about personal finances, interest rates, credit scores, credit reports, but there are a lot of things that are similar to interest rate that impact interest rate, that impact our decision about finances. So we'll go over kind of managing personal finances in general and some specifics about those topics about interest. How do you find your credit score? What does that mean? And what is a credit report? It's like someone's keeping track of you. Maybe they are. Okay. So before we get to those details, what do you feel when you hear about financial planning? I know there are some students who are, I think, seniors. So by now you have made a lot of financial decisions. But if we have some freshmen, junior, maybe you haven't made a lot of financial decisions yourself. So how do you feel? Like confident, super cool? You know what? I got it down to the art form, all ducks in the row. Or to the other end of the spectrum, I have no clue. I don't want to talk about finances. It scares me. It stresses me out. So throw it in the chat, 1, 2, 3, 4, 5. If you want to speak up, please feel free to do that as well. Let's see what we have. Anyone willing to share your two? Good. Okay, you understand it, but implementing, okay. That's very encouraging. Okay, we have a lot of twos. In between, okay, maybe 2, maybe 3. Know a little, but want to learn more. All right, so we are at 2. We understand it, but we haven't implemented it. Okay, so let's start with a scenario. My favorite thing, come up with scenarios. Some of you may be working part-time, full-time, definitely looking for a job as soon as you graduate. Well, what's a perk of the job? You get paid. Okay, so imagine a person who works very hard and they get paid, but as soon as you get paid, you are thinking about all those things that money is going to go. Well, you got to pay the bills. There's education, there's the car, transportation, maintenance, insurance, gas, you name it, cell phone. But you would also like to buy something for you, shopping, nice food, necessities as groceries, like snacks. There are lots and lots of demand on your money. And getting paid is the best thing that happens during that particular week, month, whatever that is. Payday is the best day. Are you with me? I think so. Now, What if you wake up with a headache, maybe flu, maybe just not in the mood to go to work, or a text from a manager, I don't need you today. Worse, we don't need you anymore. What happens? That payday is not there. It's a lot of stress. You don't work, you don't get paid. You don't get paid, you don't get to pay bills. So when those situations happen, and they are more often than you might think, there are a lot of people that go unemployed not by choice. One thing is to draw on your borrowing. Okay, I have a credit card. I don't know how much money I can put on it, but I have to pay bills. I have to buy necessities. I have to buy groceries. You could be that person. Or you could be the person who opens the drawer and finds a stack of money, who walked in your door and did that. Guess what? Nobody. You did it. Remember when you were saving? Every time you got paid, there was little bit change that you would put aside, whether it was a jar, a piggy bank, or you went to a bank. All of that you were paying yourself. And one of the basic rules in managing personal finances is you are going to pay for groceries, your transportation, your tuition, your housing, your medical gym needs, wants, you name it. And then Uncle Sam comes before everyone, takes taxes out of your paycheck. But guess what? You should be the first one you pay. Pay yourself, pay your future self. You'll be thanking yourself over and over again if you do that. If you make it a habit, every time you get paid, pay your own bill, your future self. And once you start in the habit of doing that, yes, it's good to save money aside in a piggy bank, in a jar, under the pillow, and that will add up. And that's a good thing. But if you factor in the interest rate that you can earn on your savings can not only add, they can multiply. They will increase by a lot more than if you were just putting money aside. And how can you get that interest rate? Who is paying you that interest rate? So you have your traditional banks. You have your Claybrook Bank, IBC, Frost Bank, American Bank, Wells Fargo, Bank of America, Chase. You keep on going. There are dozens and dozens of banks. All of those banks can help you save your money and pay you some interest rate. There are also credit unions. Credit unions typically pay more interest than banks if you're saving with them, but they usually also, excuse me, have a qualifying criterion. So there may be a teacher's credit union. You have to be a teacher. There is a Navy credit union, Navy Army, you have to be in the Veterans Armed Services. There is a Coastal Bend credit union. You live in an area, you could qualify for that. So they are not open to everyone. You have to be a member, and to be a member, they put in the criterion. You fit in the bill. It's not that difficult to find 2 or 3 credit unions in the area that you live in that might take you, and they do pay higher interest rate. If you don't feel like going to a bank, going to a credit union, and want to do everything online, and I don't blame you, everything is online nowadays. We have classes online, we have degrees online, right? You can do online banking. There are many banks that are fully online, and you will never see a branch. Discover Bank, Ally Bank, SoFi, Chime. There are many financial services apps that provide banking services, and you can get very much the same services as you would get from a traditional bank. They will even send you a checkbook if you request one. They can also print your money orders, but you'll have to do everything online, and there may be a delay if you're wanting a physical check. But most transactions can be done online. And the types of accounts that pay interest rate, we are starting with the lowest interest rate, that is your checking account, with some of the highest interest rate, which will be the certificates of deposit. Now, there is a convenience that you give up as you get higher interest rate. Checking accounts, you have instant access to your money, even more so than money in your room, because you can forget that money in the room and be at a restaurant. But if you have a checking account, you would have a debit card that you can use anywhere as long as you have your debit card with you. But they pay very low interest rate. However, last couple of years, there have been many online accounts that are paying a good interest. And by good, I mean anywhere from 3.5 to up to 5.5. There is a bank in Austin that pays 5.5 interest on checking. They make you use their debit card a few times a month, but that's a very healthy savings. Interest rate that you can get on your saving while having instant access to your money in the checking. As you move from checking to the savings, now you will get a little bit more interest rate, but you don't have as much access to your money. They will limit how much money can you take out of your saving in a given month. How many transactions can you make? Usually they won't give you a debit card for your saving. Even if they do, they will say you can't use it more than X number of times in a month. And that could be problematic. But why were you saving? Because you didn't want to spend it. So it serves the purpose. You put the money aside, you don't want to use it, you should not use it, and you get higher interest rate. The third level, which is even more interest, which is a certificate of deposit, but now you're talking about a fixed time period. Forget about 5 transactions a month like a saving. Now you don't have any transaction. If you make a CD for 3 months, don't look at your money for 3 months. You'll get it after 3 months. If you want it before, you won't get the higher interest that they promised you. So they would have a term 3 months, 6 months, 9 months, a year, 5 year, 10 year, even longer. And interest rates are specific. In addition to term, they also have certain deposit requirements. Some might only allow you to put a CD if you have minimum 5,000. Others might say we start with 1,000. They may also have an upper limit. If you start saving a lot of money, you want to get a high interest. They may not pay a high interest more than, let's say, 20,000. So there are limits you have to work with. But nonetheless, as you lose the options on access, you're rewarded with higher interest. All of these options, checking, savings, CDs, banks, credit unions, online financial accounts, they are all guaranteed money. They are insured by FDIC, Federal Depository Insurance Corporation. This is a subsidiary of the Federal Reserve, and it is backed by full faith and credit of our government. So even if you think it's an online bank you have never seen, you never heard about it yet, where is it? It's all online, and they happen to shut down. If it's a legitimate bank, it will be insured with FDIC. It will show that in the front page. If it is, your account is insured up to $250,000. And that is more than enough insurance for more than 90% of American savings accounts. If you're saving more money, guess what? You can put it in multiple accounts and you can have this $250,000 insurance in different accounts. If you have $1 million, you can have 4 accounts up to $250,000 and your money is all insured. That's a good deal. Full insurance and a high interest rate. Interest is not only what you receive when you open accounts with banks, credit unions, etc., or directly lend it to someone. Interest rate is also what you pay when you borrow money. Some of you may relate to that. Student loans, right? Right now you're borrowing. You may not be paying interest, but as soon as you graduate, a few months after, it's going to start accumulating interest and you'll have to pay it back. If you use credit card and you don't pay it in full every month, there is an interest you have to pay. Many times people take personal loans, whether it's for a home renovation or a vacation, whether it's a necessity or a want. Those loans have interest rates. Car payment is a typical interest rate loan that most people have to take because cars are expensive. The average price of a car right now is $47,000, $48,000. More people are not walking around with that kind of money. They have to borrow that, and they're making a car payment, and it includes loan. The biggest amount of borrowing that we do in this country and in most other countries is the biggest purchase ever in your life. That's going to be your house. The average housing cost in Texas is more than $400,000. If we didn't have 40,000 for a car, guess what? We don't have 400,000 for a house. So that mortgage payment, that loan includes interest. And we have to consider whenever we borrow, we are not just paying back what we borrow, we are also paying back a lot of interest on that. Now, when it comes to interest, a typical contract, a typical account, you would see the word APR. It's very common, annual percentage rate. That's the percent they are simply telling you on a yearly basis. This is what they will either pay you or charge you. So let's say 6%. If you put $100 in a bank account and they would pay you interest after a year, that would be $6 on $100. If you took a loan and that was the APR loan, $6 interest on $100. But almost every transaction, whether you borrow or you lend, would have a lot of fine print where they would say, yes, we have the APR, but APY is this much. APY is the annual percentage yield, which in technical terms, if you take any of my finance classes, we say it's the EAR, effective annual rate. What is the real rate they are charging you? Because APR is not real. And real rate has to do with compounding, and compounding has to do with interest over interest. As we borrow money or as we lend money, you don't wait an entire year to get your interest. Interest is typically paid monthly, weekly, sometimes daily. Okay, let me see, why do we have the annotation? 1 second. There we go. So here's an example of compounding. If you saved $100 for 1 year, you would get $106 a year after. That would be your 6% simple interest rate. If you left that money for 2 years, one would think you would get $6 for the first year, $6 for the second. That should be $12. But compounding lets you earn interest on interest. So next year, when you start with 100, you also leave your $6 previous year earnings. So you're actually starting with 106. You're getting extra 36 cents. What is that extra 36 cents? Well, if you leave your money for long enough, let's say 10 years, you are getting extra almost $19 for $100 saving. That's 20% extra income than just the $60 that you would have earned if it was a simple interest. Now, if you were to even go further than annual interest, and let's say you were earning monthly interest of 0.5%, and I will show you in a second why half, not 6, your money will actually grow to $182 instead of $179. Now, who cares for $3? Well, you're not saving $100. What if you were saving 1,000? That's extra $30. What if you have a job? You got a bonus, you save 10,000, that's extra $300. What if you have accumulated savings for retirement, extra 100,000 savings? Well, you're getting 3,000 extra. That's a lot of money. So even though it doesn't look a lot, compounding makes your earning grow much faster. So here's a simple example that I would like to walk you through so that you understand what compounding is. Let's start with $1,000 today, and you could get 6% APR. If it was simple, 6% of 1,000 is $60. A year later, you would have 1,060. If the contract said you're getting monthly compounding, in that case, your 6% is being divided by 12 months. So you're getting 0.5% every month, which should add up to 6%. 12 months, 0.5%, that's 6%. But let's see, first month, your $1,000 gets you 0.5%, which is $5. And month after, now you add $5 to your 1,000, you have a 1,005 savings, and you get another 0.5%. Instead of 5, this next month you're getting $5.02. The month after, you add those $5.02 to your previous 1,005. Hey, this month you got extra 5 cents. Those little cents keep on adding up. By the 12th month, you would have added extra 28 cents on that month's interest. In total, you're getting extra $1.68. So instead of getting $60 interest, you got $61.68. So your annual percentage yield was not 6%. It was 6.17%. So if you borrow money and the car dealer says your interest rate is 4%, your interest rate is much higher than 4% because they are charging you interest on every day on the loan balance. If you borrowed a car for $45,000, whatever the daily interest rate is, that would be, if annual is 4, that would be 4 divided by 365. They're charging you interest every day, which means next day they're charging you interest on interest. So whatever your APR is, your APY or EAR will definitely be higher than that. So when you borrow money, it's good to read the fine print. It's good to read how often the compounding is and what are the effects of compounding. So here's an example of effects of compounding that I have for you, a savings calculator. Okay, so let's see. We are not going to put any money right now. Okay, we are students. We don't have a lot of cash right now. We have 0. Let's leave it at 0. But we can start with monthly $200. Most of you are in the age group of 20s. If you keep that savings for many, many years, not just 10 years, let's say until you retire, typical retirement age 65. So if you're 20, give me a number, 65 minus 20, you have 45 years that you can save your money. Right now, the banks are paying about 4.5% interest. 200 a month will get you to $340,000 in your account as you retire at age 65 if you start saving right now. Well, let's start saving 5 years later. I don't have a full-time job. You know what? Savings are good, but I can't put money aside right now. So I will start saving when I am 40 years old. You almost lost $100,000 just for 5 years. Problematic. But guess what? When you have a job, maybe you can save $1,000 a month. If you have a $6,000-$7,000 monthly paying job, pay yourself about 10-15%, save $1,000. Hey, you're a millionaire. How does that sound? It's not that difficult to be a millionaire. It just takes some dedication, savings, and a good earnings. But you don't only have to save in banks. You can also invest in bonds. You can invest in stocks that usually pay higher interest rate, and your money can grow. And you want to see how much it will grow? You have 1.3 million. Let's make it to only extra 1% to 5.5. All right. That's a lot more money just by extra 1%. So if you can earn more interest, you get a lot more money. So what I want you to do right now, maybe take a minute and I will post this savings in the chat. Try it out for yourself and see how it works. Think of your goals. No one's watching what you're doing. Think of your time frame. When would you like to retire? Maybe you're the one who says, I would like to retire at 45, not 65, but you have less time to save. But you may need to save more money. Okay, so here's in the chat. Click on that. Spend a minute. It's 3:24, maybe at 3:27. Come back, and if you want to share, you're welcome to. If you don't, that's perfectly fine. Okay, so once again, the savings calculator, I posted the link in the chat. Based on your comfort level, find out your goals. Maybe you want to have $5 million when you retire. See how much you will need to save and how much interest you will need to earn, and maybe how many years you will need to work to be able to do that. This is all up to you, where you want to be, and this is all your decision. Any questions for me to use this, how to use the saving calculator, any input you would like to get clarification on?
Do you have any online banks recommendations with a yield at 2.4%?
Right now, SoFi, which is an online app, and they are also FDIC insured, they are paying almost 4% on checking account.
All right.
But they would require you to have a direct deposit. So any account that's paying you high interest, they will put in some requirement. American Express, which is known for credit card, they also have a savings account, and their interest rate is in the range of 3.5%. Discover Bank is in the range of 3.8 to 3.9. So online banks are able to actually pay higher interest because their costs are lower, because they don't have to maintain a big brick and mortar branch network all across the country. So their costs are lower. Their services are also a little bit less because you can't just walk into a branch and talk to a real person, which a lot of people who are used to the way they do banking, they're not comfortable with online. But most of the today's generation, they can get almost everything with the online banking as you would do with a traditional bank.
Thank you.
Okay. So let's go back to now, once you start saving and start making strategic decisions about saving, there is also strategic decision about spending. When we earn money, pay yourself first, then you have to pay your bills. A lot of the times, people use credit card for convenience. Sometimes they also use credit cards because they don't have enough income and they have to borrow money, even if it's short-term borrowing. Maybe it's a few days. You can use your credit card until the payment day, and then you'll get paid before that, but you have to be disciplined about it and be able to pay. So credit card sometimes have a bad rep, and there is a good reason for that because a lot of people don't know how to manage their credit cards. But if you use it wisely, they can be actually a good utility tool in your holistic financial planning. So first of all, it helps you build credit history. Well, unlike your history class, which is very interesting all the time, your credit history is very interesting to your prospective future lenders. Remember the car, $45,000, the house, $450,000? It's very difficult to get to that level of saving by the time you need a car and you want a house. So you would need to borrow money. And to be able to borrow that large amount of money, you would need credit history. Someone will need to know that you were able to manage your credit card, your borrowing, you were paying on time, you were diligent about how much money you were borrowing against your credit line. All those things add up into your credit history. And a credit card is a good way to start. If you don't have any credit card right now or any type of borrowing, you usually would not have credit history. So to start building credit history, you would want a credit card. That's the easiest way to start. Some companies may not give you a credit card without credit history. Well, that sounds like a catch-22. I need one to build history. I don't have history. How do I get one? Many banks offer secured credit card. What that means is if you open a savings account with them and if you put, let's say, $500 in a savings account, they will actually give you a credit card that is secured and that has a limit of $500. Well, you're not really borrowing money, you are simply learning how to use credit. Anytime you use your credit card, pay back on time, build your credit history. If you don't pay back, well, bank doesn't have to trust you. Why? Because they have the savings money from your account and they will pay themselves back. So that's a good way. Another way is to find a family member who has established credit history and who is willing to put you as an authorized user on their credit card. Now, when they do that, they also assume the risk. If you put large purchases on a credit card without their approval, they will be on the hook to pay. So not only can you not make your history look good, you can actually make their history look bad. So people are careful about extended relatives. Immediate family should not be an issue to help you get started on building your credit history. At the same time, emergencies happen, and credit card is there sometimes to deal with those emergencies. You can't go to a bank to get a personal loan because that can take a while to get approved and get your money. And your friend may not have enough cash to support you in that emergency. If you have an approved credit card with a high enough credit limit, you can use it for emergency. But be careful what you define as emergency. Putting money for a daily Starbucks run on a credit and not having that money to spend is not an emergency. So be careful how you define your emergencies. And they should be extremely rare occurrences that you're borrowing on a credit card for an emergency, but it can help you. Nowadays, many banks, many financial institutions also offer a lot of perks with a credit card because every time you swipe a credit card, the bank gets paid. You swipe it for $10, about 5%, which is like 50 cents, goes to that bank. The shopkeeper has to pay that. The merchant has to pay that. That's the fee of convenience, and it's built into the prices you're paying. And they're not giving you any cash discount. So might as well get the benefit. Some of the common benefits, they will outright give you cash back, 1%, 2%. So if you end up spending $500, 2% means every month you get $10 back. That's a discount on everything you are buying. That's a good deal. Some would offer you travel miles. Last year, I was able to purchase tickets for my parents to go to India on miles. I had accumulated so much. Dollar price was like $1,700 per ticket. If I counted all the miles I had earned, I probably spent about half of that. Free miles and extreme value. They also offer rental insurance. As you rent a car, many times you would buy insurance from the rental company that adds up your rental cost from $50 a day to $80 a day. If you use a credit card to rent, most of the times those credit cards would include rental insurance as part of their package. Sometimes there are entertainment concert tickets that they will send your way. Fraud protection. If you're using cash, if you're using debit card, you still have fraud protection on debit card, but not as much on cash. If someone sells you counterfeit stuff, you buy something that breaks down. Credit cards also offer you extended warranty. Any unauthorized transactions that you claim you did not do, they will inquire about it. And in most cases, if you are truthful, you will not have to pay for some fraudulent charges. And sometimes they will send you gift cards as a shopping credit, which is like a cashback. So there are benefits of having credit card and using credit card if you manage it wisely. There are many blogs. There's a travel guide, there is a points something website. They talk about people traveling around the world without spending a penny on airfares. All they are doing is credit cards, their regular purchases, whatever they can buy on regular every day, they're using credit card, but they're not borrowing money. Anytime they use credit card, they pay back on time. Why? Because it's expensive to borrow money. Remember the 4% sounded like a high interest? Well, if you borrow anything on a credit card, they'll charge you anywhere from 15 to 30%. And that's APR, which means the EAR will be much higher than that because they're charging interest on a daily basis. And that's a very high cost to borrow money for unnecessary wants. And interest may not be fixed, it may be variable, that it changes over time. It can increase, especially if you are not paying on time. And there are hefty late fees penalties. And there is a fallacy about people, hey, I'm making the minimum payment, I'm on time. Not really. Minimum payment only saves you the late fee penalty, but you still have to pay interest on any balance you're carrying. Anytime you carry a balance, your credit card statement will tell you if you keep paying the minimum, this is how long it will take you to pay back, and this many dollars you will pay extra as interest. So be careful. And that carefulness is because of the facts that we have. This most recent year, 2024 data from Federal Reserve of New York, $1.17 trillion in credit card debt. That's one followed by 12 zeros. That's a lot of money we borrow as a nation and we put on credit card at a high interest. You're not getting paid that interest no matter where you save that money. Compare that to auto loans, which is kind of second largest purchase in most people's life, and that is only 387 billion. People are putting a lot more money on credit card and they don't know how to manage it. That's why we have so much debt on credit card. So if you use credit card, please be very careful because borrowing too much or missing a payment, instead of building credit history, you'll be hurting your credit history. And talking of credit history, you're building your credit score. If you are strategic about your borrowing, it can help you as you move forward, as more years pass, as you build the payment history, as you borrow a little bit, pay back on time, your score keeps getting improved. And there are benefits of that. In terms of score, who's keeping that score? In the United States, we have three agencies, Equifax, Experian, TransUnion, and they are keeping that score. Every time you open an account, those banks are reporting those inquiries to these three agencies. Every time you make a payment on time, they're also reporting that, hey, you're a good guy. Every time you miss the payment, they do that too. A lot of the information is going through those institutions that you self-report. When you open an account, well, you got to give your name, give your mother's maiden name, you give your social security, give your address. You also give your employer information. They will feed all that into credit ratings. So they know that. It's imperative that you verify what's going on with your credit score and credit report. When it comes to the scores, there are two major models that most lenders look at, FICO and Vantage score, and they range anywhere from 500 to 850. As you see in the little meter going on there, good, very good, exceptional. Most people would tell you there is little to no difference between very good and exceptional except for the bragging rights. And who do you share those bragging rights with? I don't see people telling me their credit score very often. So if you get past the good to very good, you're already qualifying for the best interest rate, you're qualifying for the best borrowing, and there are many other perks. If you think of credit score, that's like your GPA. And how is your GPA determined? It's determined based on your transcript. What did you do in your courses? So your credit score is based on how did you manage your past credit? That's all in the credit report, which is like your transcript. Biggest benefit, if you need to borrow money, having a good credit score will help you borrow when you need it, whether it's a renovation, emergency fund, a car loan, a home loan. A good credit score, lenders will want to lend you. Why? Because they'll feel safe letting you use their money. You also qualify for lower interest rate, and that can mean big difference. So just a quick illustration on what type of difference we are talking about. Okay, so I'm going to just look at the borrowing cost for house. Okay, no taxes, nothing. We'll go with a smaller house, let's say $350,000 house, which is less than the average cost of house. And we don't have $70,000 as a down payment, so we have 50,000 that we would have saved by the time we are buying a house. So we are borrowing 300,000, and typical home loan lasts 30 years. And interest, if you have bad credit, you may not qualify for these interests they're promoting 6.16, 6.19, 6.26. You will end up paying high interest rate like 7%. Okay, so let's do a quick math on that. Your housing payment would be $22.34 per month for a $350,000 house for which you have paid 50,000 down payment. You're borrowing 300,000. Let's look at how much interest you will pay during the life of this loan. Oh, you only borrowed 300, but you paid $421,000 in interest. That's a lot of money. In total, your house costed you 721. Now let's have a good credit. Okay. What do I mean by that? If I have good credit, I will qualify for even better than 6.2. I may qualify for 5.5%, better than the average. And if I do that, I have dropped my payment by almost 300 a month. Oh, 300, is it a lot? Let's see. Yeah, it is a lot. How much money I saved on interest? Almost $100,000 just because I had good credit. So it makes a difference if you have good credit versus if you have bad credit. And it makes a difference for any type of loan you take because you'll end up paying a lot more if you have anywhere good to bad credit. Very good, exceptional, you're getting the best rates, best deals. Many times, if you're renting, your landlords will actually run your credit because they will determine are you going to be paying your bills on time, and they use your credit score on that. And sometimes there are deposits they will require you to pay. Your auto insurances do the same thing. Bad credit, high rate. Good credit, low rate. Utility companies will not require a deposit if you have a good credit. You want to get electricity in the new house, bad credit, you might have to put $500 down in case you don't pay the bill. And sometimes employers use it too, especially financial institutions, because they want to know that you can manage your finances. How are you going to manage someone else's finances? Some of the things that can help you establish credit, the biggest one is being on time. If you borrow money, pay on time. This is from Experian. I looked at Equifax, I looked at TransUnion, very similar ratio. About third of the score is based on your history. Do not miss any payment. Another third is based on how much you're borrowing against your credit limit. So if you have a credit limit of 2,000 and every month you end up spending 1,500 on that, that's not a good sign. Typically, they would recommend that you owe less than 30% of your available credit. So we are talking about $30 on every 100. So if you have a credit limit of 2,000, don't go above 600 on your monthly bill. And when you get a bill, pay on time. Both these things will have the biggest impact on your credit. The smaller impact is length. This is out of your control. When you start building credit, you don't have any length. So it will have a negative impact. But 5 years, 10 years down the road, it will start having a positive impact. Another smaller impact is new credit inquiries. If you open a lot more accounts in a short period of time, they think you need a lot of money. You need to borrow money, and that's bad for your credit. So time it accordingly. Typically, an inquiry stays on the credit report for 2 years. Having two inquiries in a short period of time may not be too bad. Having five, probably bad for the credit, but the impact it would have about 10%. And lastly is the type of credit mix. Is it only credit cards do you have, or do you have credit cards, student loan, home loan? If future lenders can see that you're able to manage so many different types of borrowings and paying on time, that's the plus compared to someone who's only borrowing one type. So it sounds counterintuitive. You have to borrow more money and different types of money to be a good borrower. Not borrowing doesn't make you a good borrower. That's what I meant by credit cards can help because they are starting into getting your feet wet in the borrowing world. And credit report that spits out the credit score is based on all that data that is being reported: personal data, credit accounts, amounts, what you borrowed, how much you paid, did you pay on time, any recent inquiries. All of that will be included. In addition, if there were any collections, if you didn't pay at all and the bank sent it to collection, if you have any public record, any filing that, like alimony, child support, if someone is not paying those on time, they will be reported in there too, and that will have bad impact on the credit. Why you should be careful about credit report and monitor it frequently. First one, accuracy. Yes, those companies are reporting that data, but they can make a mistake, and you can verify, you can cross-check it. The second best reason to do that is fraud detection. If someone is opening accounts or someone is using your account without your permission, that data should show up. Or even worse, identity theft, which is more common than you might think. People stealing your information, people stealing mail from your mailboxes, and sometimes it may contain your name. Well, of course, it has your address. Sometimes there is a date of birth. There are data leaks everywhere. People stealing your social security. They can open accounts under your name. If you keep monitoring your credit report, you'll be able to see, and you're able to dispute all that with evidence and get those removed if there is some problem on it. But what is the biggest reason you should monitor, even if you're not scared about any of that? Find areas for improvement. If your credit score is stuck between good and bad, how do you get out of there? Look in the report. Are you missing payments? Are there late payments? Are you opening too many accounts? Are you borrowing too much money? Your credit report will help you guide that. And you have access to it for free through the federal government. There is a law, and this is a legitimate website, annualcreditreport.com. And I will post it in the chat box as well. And what they let you do is request your free report, and you'll have to fill out a lot of personal information like your social security, your previous addresses, and things like that. And it will allow you to pick which report do you want from the 3 agencies. All of those are free once a year. So be careful. Time it accordingly. Don't go check all 3 right away. Check one. 3-4 months later, check the second one. 3-4 months later, check the third one. By the time it's the new year, you have 3 free accesses again. That would allow you for a continuous monitoring for free of charge and being able to stay on top of your credit. Okay, so let me put that link in the chat, annualcreditreport.com. So remember, personal finances is not a one-time decision. It's a journey. It's a continuum. You have to keep making the right decision. And yes, even one bad decision can hurt, but you can overcome that bad decision by making many more good decisions. A good start is helpful, but sometimes it's out of your control. Sometimes there are other people making financial decisions on your behalf, and maybe they have all good intent, but they're not educated in financial literacy. They may not have the knowledge and information and resources, and you may have bad credit to start with. But it's the continuous improvement that you need to do. And you can do that by following those key aspects of managing your credit well, understanding the interest rate, understanding the credit reports, and monitoring it. And when it comes to saving, it's never too early. Yesterday was the time you should have started saving. If not, do it right away. Whatever you can, get in the habit. You may not be able to open a high yield savings account right away, but get in the habit of paying yourself first. And that habit can really serve you well when you make a large income, because then you'll be saving large amounts. When you make financial transactions, read the terms. Yes, it's easy to skip those many pages, but you're signing your financial future off to someone. So make sure you read the terms. Yes, it will take you an hour. You're educated. You go to college. You know how to learn, read. You know how to understand. If you don't, ask questions. It's well within your rights. Now I'll stop for questions, comments, like to connect with me, send me an email. Any questions you have after the presentation on LinkedIn, here is my handle on the LinkedIn.
Thank you so much for the seminar today.
You're very welcome. Anyone with question? Now, if we go back to our confidence number, everyone was 2. Well, we don't know how to implement it. I hope some of those 2 turned into 1, that you are more confident today, that you can go open that high yield account or maybe inquire about the credit card. Don't go opening dozen credit cards for all the rewards. That won't help you. Be careful.
No questions? Well, before you go, thank you. Thank you, Harmeet, for the presentation. It was very informational. If you guys have any questions that they come back or that you're wondering later on, I do have a survey before you go. Let me share the screen so that you can see it. Tell me if you can see it. Can you see it?
Yes.
Okay. If you want to take a few seconds to do the survey real quick, it'll give us an opportunity to also get feedback from you guys. If you have other topics that you would like us to discuss for next month's series. If you have questions for Professor Harmeet, if you have any other suggestions or ideas, this is where you guys can share that and we can look into it and make sure that we do that for you guys. If we have other questions, yes, sir.
And if any of you have open electives in your degree plan, I teach a personal financial planning class in summer, which is a fully online class.
Okay.
And we kind of do this whole thing for an entire month, and not just about opening accounts, but also about taxes, insurance, getting a loan, writing a will, all stuff, personal finances.
Things you will need to know. Things I wish I knew when I was in college. So take good notes. Make sure you leave a note, any ideas on the survey, and be on the lookout for next month's webinar with new topics. So we don't have anything else. I want to thank again Professor Harmeet for your presentation. Hopefully this won't be the last time that you present to our students. We would love to have you back as one of our own in campus.
I'll be happy to do that.
Yes. So we'll say goodbye for now. We'll see you soon. Thank you for joining us. And like I said, just go ahead and fill out that survey so that we can get more ideas out there for you to be useful. We'll see you next month. Thank you so much, everyone.
Thank you, everyone. Bye-bye.